You notice it before the day has really started. Not because anything dramatic happens. There is no call from a bank. No letter sitting on the counter. No warning message on your screen. Just a small payment leaving your account. A monthly charge. Small enough to ignore. Familiar enough to accept. It does not interrupt your morning. You still make coffee, you still check your phone, you still open your inbox and move through the ordinary routine of the day. And that is exactly why it works. Debt does not always enter your life as a crisis. More often, it enters as convenience. A smaller payment. A quick approval. A clean little option that lets you get something now and move the full weight of the cost somewhere into the future. It does not feel like losing control. It feels like handling life. It feels practical. It feels normal. A few dollars here, a payment plan there, a balance that can wait one more month. A purchase divided into pieces so small that none of the pieces feels dangerous by itself. But the system does not need the payment to feel dangerous. It only needs the payment to become part of the rhythm. Because once part of your future income is already assigned, your money begins to arrive with instructions attached. Before you earn it, part of it has already been claimed. Before the month begins, part of the month has already been spoken for. And that is where debt begins to change shape. This is not a story about whether debt is good or bad. That question is too small. Debt means different things at different levels of the system. At the bottom, debt is close and personal. It is a due date, a balance, a minimum payment, a quiet pressure around the next decision you want to make. In the middle, debt becomes a tool. It can buy time, open a business, expand a company, or keep an institution moving when cash is not enough. Higher up, debt becomes something colder, a claim, a contract, a priority, a right to be paid before someone else, a structure that can shape behavior without looking like force. And at the highest levels, debt is no longer only about one borrower and one lender. It becomes part of the architecture that decides who gets access to capital, who receives better terms, who pays more for time, and who loses options when conditions tighten. So the question is not only how much you owe. The deeper question is what the debt requires from you. What it gives. What it removes. Who holds the claim? And what part of your future has already been priced before you arrive there? Level 1. Personal debt. At this level, debt feels close enough to be real, but small enough to explain away. A credit card balance. A student loan. A phone financed over 2 years. A laptop payment. A medical bill split into installments. A buy now, pay later charge attached to something you barely think about anymore. Each one has a reason. Each one made sense at the time. The card covered a gap. The loan opened a door. The phone was necessary. The payment plan made the price easier to carry. Seen alone, none of it feels like a system. It feels like ordinary life. The minimum payment creates relief because it keeps the problem small for one more month. The installment plan makes the full cost feel distant. The credit limit increase can feel like progress, even when it is only a system deciding you can carry more weight. And because nothing collapses, you assume the structure is working. You pay enough to stay current. You avoid the late fee. You protect the score. You keep moving. But underneath the routine, time starts to behave differently. A purchase from months ago is still taking money from this month. A decision made quickly is still waiting for you every billing cycle. Interest does not need your attention to keep working. It continues quietly, whether you check the account or not. That is the hidden cost of the first level. Debt becomes manageable enough to stay. It does not control you by terrifying you. It controls you by remaining tolerable. You are not ruined. You are not failing. You are simply carrying small obligations that begin to shape the edges of your choices. You wait before changing jobs. You hesitate before moving. You think longer before taking a risk. And slowly, debt stops being only a number in an account. It becomes a quiet claim on your flexibility. At first, the claim is small. Then, there are more of them. A small balance here, a finance device there. A payment you barely notice until it shows up again. And when enough small payments become fixed obligations, debt moves out of the background and begins to shape the life around you. Level 2. Household leverage. At this level, debt no longer feels scattered. It starts to look organized. A mortgage. A car loan. Insurance. Property tax. Maybe a home equity line attached to the value you have slowly built. From the outside, this looks like stability. A fixed address, a vehicle in the driveway, a job that pays enough to keep the structure moving, a life that seems more settled than it used to be. And in many ways, it is. You are not living month to month in the same way. You have more income, more credibility, more access to better terms. The financial system begins to recognize you as someone who can carry larger obligations. But that recognition has a cost. The mortgage does not only give you a home. It ties you to a place. The car loan does not only give you movement. It adds another fixed number to the month. The home equity line does not only unlock value. It turns part of your house into another claim. You may be earning more than before. You may look safer from the outside, but the space around your decisions has become smaller. A job you dislike becomes harder to leave. A city that no longer fits becomes harder to exit. A business idea becomes easier to delay. A risk that once seemed possible now has to pass through the mortgage, the car payment, the insurance renewal, the tax bill, and the rate on borrowed money. Debt at this level does not need to destroy you. It only needs to make every alternative feel expensive. That is the hidden limit of household leverage. You gain stability, but you give up some mobility. Your life looks stronger from the outside, while the inside becomes more fixed, more scheduled, more dependent on everything continuing as expected. And for many people, that trade feels reasonable. They protect the house, they keep the job, they make the payments. The structure works, so they stay inside it. Not because it feels perfect, because it feels safer than the unknown. But some people want more than stability. They want control. They want to build something of their own. And when debt moves from the household into a business, it stops being only a monthly obligation. It becomes the clock the business must run against. Level 3. Business debt. At this level, the word owner begins to enter your life. Other people may say it with admiration. Business owner, founder, operator, self-employed. It sounds freer than employee. It sounds like control. You lease space, you buy equipment, you hire help, you purchase inventory before the customer has paid. You borrow not to consume more today, but to build something that might produce money tomorrow. From the outside, this looks like independence. You make the decisions. Your name is on the account. Your hours belong to you, in theory. But the debt introduces a different kind of supervision. No manager may be standing over you, but the obligation is still there. Rent is due whether sales were strong or weak. Payroll arrives before every invoice clears. Inventory has to be paid for before it becomes revenue. A client can delay payment, but your lender does not delay the schedule. This is where you learn that profit and cash flow are not the same thing. Not as theory, as pressure. A business can look healthy on paper and still feel fragile in real time. The spreadsheet can say the month worked. The bank account can say the timing is wrong. And if you signed a personal guarantee, the wall between the business and your private life is thinner than it appears. The loan may belong to the business. The consequence can still follow you home. That is the emotional truth of this level. You may be freer than you were as an employee, but the pressure is heavier. Other people see independence. You see timing. You see payroll before receivables. You see how many days the business can survive if one large customer pays late. Debt here does not simply limit your choices. It converts time into obligation. Every slow week has a cost. Every delayed payment has a shape. Every quiet day is not only quiet, it is expensive. The hidden cost is that ownership does not remove pressure. It concentrates it. You wanted control, and you gained some. But control at this level still depends on lenders, customers, payment cycles, supplier terms, and cash arriving on the right day. And that changes how freedom feels. It is no longer just the freedom to make decisions. It is the responsibility of making decisions while every delay has a price. When debt grows beyond one owner and becomes part of a larger organization, the pressure does not disappear. It becomes cleaner, more technical, easier to present. Level 4. Corporate credit. At this level, debt is no longer discussed in the language of personal anxiety. People do not talk about whether they can make the payment this month. They talk about facilities, covenants, maturity schedules, liquidity, refinancing, capital structure. The numbers are larger, but the tone is calmer. The debt belongs to the company, and the company has departments, models, forecasts, advisors, and banking relationships. The obligation is no longer sitting alone in one person's account. It is spread across a balance sheet. This makes the debt feel more professional, more controlled, less emotional. But it is still debt. It still has terms, it still has deadlines, it still has conditions that must be respected. A company can use credit to buy time. It can survive a difficult quarter, fund expansion, smooth cash flow, or refinance short-term pressure into longer-term structure. That is the visible reward. Debt becomes a tool. But the tool is not free. Every lender agreement creates a boundary, Every covenant defines a line the company cannot cross without consequence. Every maturity date becomes a future test. Every refinancing window depends on conditions the company does not fully control. Market rates change. Credit appetite changes. Revenue misses. Margins compress. And suddenly the language that once sounded clean becomes sharper. Liquidity is no longer abstract. Covenant headroom is no longer comfortable. Refinancing is no longer automatic. This is the hidden limit of corporate credit. The company may look powerful, but part of its freedom belongs to the terms it accepted earlier. The vocabulary has changed, but the structure remains. At the personal level, the words were balance, due date, minimum, payment. At the corporate level, they become facility, covenant, maturity, liquidity. The language becomes colder as the system becomes larger. The emotion is removed from the sentence, but not from the consequence. And once debt is no longer used only to operate a company, but to buy one, the next level begins. Level 5. Private equity leverage. At this level, debt is no longer used to keep a life stable or help a company get through a difficult quarter. It is used to buy control. A business is studied. Its cash flow is measured. Its margins are compared. Its weaknesses are named. Then it is placed inside a deal structure where part of the purchase comes from investor capital and the rest comes from borrowed money. The company does not simply change owners. It changes pressure. From the outside, the language is clean. Efficiency. Operational improvement. Capital discipline. Value creation. Those words make the transaction sound neutral, almost mechanical. A company had a price. Capital was arranged. A deal closed. A return is expected. Everything sounds orderly when described from above. But inside the company, the structure becomes real. A department that used to be acceptable becomes too expensive. A supplier contract becomes too generous. A manager is told to improve margins faster. A hiring plan is delayed. A team is asked to do more with less. The business may still have the same name. The building may still look the same. The employees may still walk through the same doors each morning. But the logic inside the company has changed. Debt at this level does not merely finance the purchase of an asset. It tells the asset how hard it must work after the purchase is complete. That is the visible reward of leverage. A smaller amount of equity can control a larger business. Returns can be amplified if the company performs. Capital can move faster than it could if everything had to be bought with cash. From a distance, this can look intelligent, disciplined, efficient, a better use of capital. But the hidden cost moves downward. The pressure does not stay in the model. It enters schedules, budgets, headcount, pricing, maintenance, supplier terms, the pace of work. And the people who feel it are usually not the people who designed the deal. They did not choose the debt. They did not approve the target return. They did not sit in the room where the assumptions were made. But they live inside the operating environment those assumptions created. That is why this level feels colder. Not because every person involved is cruel. That would be too simple. It feels colder because the structure creates distance. The investor sees performance. The lender sees coverage. The board sees targets. The employee feels the pace. Everyone is looking at the same company, but not everyone is living inside the same layer of it. A decision that looks clean in a model can feel very different on the floor. A line item can become a person. A margin target can become a tighter schedule. A value creation plan can become a department with less room to breathe. And when a company can no longer carry the pressure of that structure, power begins to move again. Not toward the person with the best story. Not always toward the founder. Not always toward the shareholder. It moves toward whoever holds the stronger claim. Level 6. Distressed credit. At this level, the important question is not always who built the company. It is not always who owns the shares. It is who has the legal claim when the company begins to run out of room. A business misses expectations. Revenue slows. Cash tightens. A lender becomes cautious. Debt that once looked stable begins trading at a discount. From the outside, the company may still look alive. The website works. The product ships. Employees still arrive in the morning. Customers still recognize the name. But inside the capital structure, the future has already started to move. Distressed investors look for these moments. They do not need to love the product. They do not need to believe in the founder's mission. They do not need to have been there when the company was built. They study the claim. They study seniority. They study collateral. They study who gets paid first if the structure breaks. That is where the hierarchy becomes visible. Equity owns the upside when things go well. But credit can control the outcome when liquidity disappears. The founder may still speak as if the company is theirs. The shareholders may still believe they own the future. The brand may still carry years of trust. But when the company needs room, the person with the senior claim may have more power than the person with the original vision. This is the hidden rule of the capital stack. Ownership is powerful when the business is healthy. Claim becomes powerful when the business is weak. A debt position bought at a discount can become a seat at the restructuring table. That seat can become influence. Influence can become control over what the company must become in order to survive. Nothing about this has to look dramatic. There may be no public fight. No sudden moment where everyone can see power change hands. Only revised terms. New financing. Creditor meetings. A restructuring plan. A statement about stabilizing the business. But beneath the formal language, control has shifted. The company may keep its name. The building may not change. The product may continue. But the real question is now different. Who can approve the plan? Who can block the deal? Who can demand concessions? Who has the right to decide what survival will cost? That is the hidden cost of this level. The people who created the company can lose power not because they stopped believing in it, but because the structure above them changed the order of claims. The company did not stop having a story. The product did not stop having value. The employees did not stop caring. But when liquidity disappears, the story is no longer enough. The structure begins to speak louder. And once you understand that a claim can shape the future of a company, the next level is larger. Because countries also borrow. Governments also face terms. And when a nation runs out of financial room, debt becomes more than a market issue. It becomes policy. Level 7. Sovereign debt. At this level, the borrower is no longer a person, a household, a business, or a corporation. It is a country. A government borrows to build infrastructure, fund imports, stabilize budgets, support public services, defend a currency, or survive a crisis that current revenue cannot cover. At first, this can look like national strategy. Debt gives time. It allows the state to keep moving when the present is not enough. It can keep services running. It can fund projects that may not pay off for years. It can help a country avoid collapse in the middle of a shock. But sovereign debt carries a different kind of pressure because a country does not only owe money. It owes under conditions. If the debt is in a foreign currency, a weaker local currency makes repayment harder. If yields rise, new borrowing becomes more expensive. If reserves fall, options narrow. If creditors lose confidence, the government may still be sovereign in name, but the room around its decisions becomes smaller. This is where financial language enters daily life. A subsidy cut becomes higher fuel prices. A weaker currency becomes more expensive food, medicine, machinery, and basic imports. Austerity becomes fewer public services. Privatization becomes public assets moving into private hands. A fiscal target becomes a delayed school, an underfunded hospital, a frozen salary, or a higher tax. The official language may sound calm. Stabilization. Reform. Debt sustainability. Restored confidence. But people do not live inside official language. They live inside prices. Transport costs. Electricity bills. Food markets. Wages. Taxes. The quiet reduction of what the state can still provide. That is the weight of sovereign debt. The terms are negotiated at the level of institutions, but absorbed at the level of households. No family signed the bond document. No worker sat at the table when the condition was accepted. No citizen approved the currency assumption in the model. But the result still reaches them. It reaches them through the cost of getting to work, through the price of imported medicine, through a public service that becomes slower, through a government budget that begins to feel smaller in ordinary life. This is why debt at this level is not just finance. It can narrow political choice. A government may still announce decisions as policy, but the boundaries of those decisions may already have been shaped by creditors, markets, currencies, and the need to keep access open. The hidden cost is that a financial structure can become a social environment. A country borrows money. Then people live inside the terms. Not always immediately. Not always clearly. But eventually, the terms leave the document and enter daily life. And when many countries, banks, funds, and institutions are tied together through debt, the highest level is no longer one borrower or one lender. It is the architecture that decides how credit is priced before most people ever feel the change. Level 8. Debt architecture. At this level, debt is no longer only a loan, a balance, a bond, or a contract between two parties. It becomes an environment. Not a hidden room. Not a secret group quietly deciding everything from behind a closed door. That version is too simple. Most power at this level is not hidden. It is formal. It sits in committees, frameworks, capital requirements, liquidity rules, rating models, lending standards, policy signals, and institutional procedures that most people never have a reason to read. The power here is quiet because it looks like process. A rule changes. A model updates. A rating shifts. A bank adjusts its appetite. A regulator tightens a requirement. A market begins to demand a higher return for the same risk. Nothing looks dramatic at first. But slowly, the change reaches the real economy. The mortgage becomes harder to qualify for. The credit card rate moves higher. The company refinances at worse terms. The small business receives less room. The government pays more to borrow. At this level, the question is no longer simply who has money. The deeper question is who gets access to credit. At what price? Under what terms? With what collateral? For how long? And in what environment? A household does not enter credit in a neutral space. A company does not receive capital only because it needs it. A country does not borrow cheaply simply because it wants to. Everyone passes through a filter. Income. Assets. Collateral. Credit history. Cash flow. Legal structure. Market confidence. Institutional trust. Expected future stability. The system does not need to reject everyone openly. It only needs to price them differently. One borrower receives patience. Another receives pressure. One company receives time. Another receives conditions. One country receives confidence. Another receives surveillance. That is the quiet force of debt architecture. It decides what kind of future can be financed before many borrowers even understand the question. And because this power is distributed, it rarely feels like power. It feels like standards. It feels like prudence. It feels like risk management. Sometimes that is exactly what it is. But it is never neutral. Every framework creates boundaries. Every model defines what counts as safe. Every rule decides who can expand, who must shrink, who receives another chance, and who discovers that the cost of money has quietly changed. This is the highest level because the people closest to it are not only borrowing or lending. They are shaping the conditions under which borrowing and lending happen. They influence the price of time, the price of access, the price of risk, the price of survival. And once you see that, every level below it starts to look different. The small payment was not only a payment. The mortgage was not only a home. The business loan was not only ambition. The corporate facility was not only liquidity. The leverage deal was not only efficiency. The distressed claim was not only an investment. The sovereign loan was not only policy. They were all different forms of the same deeper structure. A claim on the future priced in the present. And that brings you back to the beginning. Back to the ordinary borrower. Back to the person looking at a payment and thinking the question is simple. How much do I owe? How fast can I pay it? How do I lower the rate? How do I earn more? Those questions matter. They are practical. They can create breathing room. But they are not the whole picture. Because debt is not only about the amount. It is about the terms. It is about who holds the claim. It is about what time does to the balance. It is about what behavior the payment quietly requires. It is about which options remain open and which ones become too expensive to attempt. At the personal level, debt turns future income into scheduled payments. At the household level, debt can trade stability for reduced mobility. At the business level, debt turns time into pressure. At the corporate level, debt becomes strategy, measured through ratios and agreements. At the private equity level, debt can buy control and push pressure into operations. At the distressed level, debt becomes a claim that can overtake ownership when liquidity breaks. At the sovereign level, debt can become policy, prices, taxes, services, and national constraint. And at the architecture level, debt becomes the environment that prices all of it. That is the inversion. Most people think debt is only something you carry, something you pay down, something you escape. But debt is also a system of permission. It tells households what version of stability they can buy. It tells companies how far they can expand. It tells investors where control may appear when others run out of room. It tells governments what choices remain when markets begin to close. Debt is not always destructive. Sometimes it builds. Sometimes it gives time. Sometimes it helps a family buy a home, a business begin, a company survive, or a country keep functioning through a crisis. But debt always asks for something in return. Not only interest, not only principal. It asks for priority. It asks for predictability. It asks for part of the future to be assigned before the future arrives. That is why the deepest question is not whether debt exists. Debt exists somewhere at every level. The deeper question is what kind of debt it is, who holds it, what the terms require, and what happens when the borrower needs room. A person who only sees the payment sees the surface. A person who understands the structure sees more. They see the rate, the due date, the collateral, the ranking, the rights attached to the contract. They see what happens if income falls, if revenue slows, if rates rise, if markets tighten, if confidence disappears. They see the difference between debt that expands choice and debt that quietly removes it. They do not need to panic. They need to read the terms. That is the quiet clarity at the end of this hierarchy. Debt is not simply a number against you. It is a relationship between time, money, risk, and control. At the bottom, it feels personal because it touches your paycheck. In the middle, it feels strategic because it expands what an organization can do. At the top, it becomes structural because it shapes who receives capital, who pays more for it, and who loses room when conditions change. The goal is not to fear every form of debt. That is too simple. The goal is to stop seeing debt as only a balance and start seeing the conditions behind it. Because once you see the conditions, you understand what the money buys.
You understand what it costs.
You understand who benefits from time. You understand who has patience and who does not. And you understand why the most important part of debt is often not the money itself. It is the structure around the money. The structure that decides what the money gives, what it takes, who receives time, who gives up flexibility, and who gets to make the next decision when pressure finally arrives.